Hello, investors. Welcome to this webinar on our latest offering. My name is Ben Frazier. I'm the Chief Investment Officer at Aspen Funds, and very excited to talk to you about our latest investment offering for our oil and gas. It's called 51 Upstream Energy Fund 7. This is something, if you're newer to Aspen Funds, you may not have seen a oil and gas offering from us. This is the first one we've done in over 18 months. So it's been a little bit of time since the last one we offered. So we're very excited to be rolling this out now. It was a great time in the market. We've had great track record and deployment by some really great assets in our last fund that I'll be sharing about in this webinar in a little bit. We've just had a ton of interest from investors. This continues to be top of mind for a lot of investors of where they want to allocate their assets is into this place. And our strategy in oil and gas is very unique, very different than a lot of other things you may be seeing out there. I'm going to explain why here in a little bit. But we also feel like right now is a really important time in the market to take advantage of what we think is a very unique, very important buying opportunity in 2025 for acquiring assets at a really good price, given the long-term trends that are going to be supportive of this asset class. So without further ado, let's dive right in and talk about the team here, the strategy, and some of the assets that we've already purchased. First off, got to give the disclaimer, as always, this is not an offering of securities. You need to review our full private placement memorandum, which will be available in our data room, and review all the risk factors and make sure you understand all the risks associated with investing in oil and gas, which can include loss of capital. And of course, any projections that I make, any forward-looking statements, any targeted returns, these are not guarantees. This is, based on our pro formas, but there is no guarantees that we can hit those numbers. So be sure that you understand all the risks involved before investing in anything like this. Okay, with that, let's dive right in. First off, you've probably seen these faces a few times if you've been around Aspen for any length of time, but want to give just a real quick recap for those who are newer to the Aspen Funds family here. So our two co-founders, Bob and Jim, started Aspen Funds over 12 years ago. And the whole story of Aspen really comes from a unique opportunity that they saw in the marketplace. At that point, it was coming out of the great financial crisis and saw a very unique buying window into distressed debt. And we continue to operate those funds and that business to this day with great success. But it really created this framework for how we look at the world, how we look for opportunities for investing, and have used that same process in identifying why we believe oil and gas is another great asset class that you want to be paying attention to. So quick, introduction by background. Bob is a former Ernst & Young Entrepreneur of the Year. He ran a tech firm for a long period of time before transitioning into finance, was a CFO, ran a hedge fund, and has been investing for over 20 years in multiple asset classes. He's well known for our annual economic forecasts. If you don't aren't on our list to get those, be sure you sign up. Jim is our resident real estate expert, also has a lot of experience in oil and gas. He started his career at Exxon. And 30 years in investing. He's been amazing on the team. Other parts of our partner team, Dan Schulte here. Dan is very experienced in private equity and is, before joining our firm and kind of a private equity firm before that, he was the general counsel at a large money manager firm in town here. And then myself, Ben Frazier, like I said, my background's in commercial banking and actually worked for a midstream investment firm before I transitioned into banking. So have some experience in oil and gas as well. And right now, the Chief Investment Officer, helping put together our deals and all the acquisitions that we bring to you guys for offerings. Really key people I want to highlight here for this fund is Mahajra Energy Advisors. And so you may recognize Jeff here and his face from a recent webinar that we just did a few weeks ago. And this has been a partnership that has been in the works now for several years that has just been a real great partnership experience. Jeff and Bob are actually both here in Kansas City. When we first started investing in this space, their name continued to come up again and again and again as key people that we need to know. And as we got to know them and spent over a year getting to know them before we even did our first deal together, really found similar value alignment, strategy alignment, and just professionalism, expertise. They're at the top of their game. And so the cool thing about this partnership is Mahajer, they've been in this space for over 40 years, and they actually started really as a geological engineering firm to really understand everything from the very basic geological starting point, and then build from there the financial models and the investment thesis over time. And so they've been doing this now, like I said, for over 4 decades, incredible track record. They've valued and helped acquisitions of over $3 billion worth of properties and oil and gas assets in that tenure. They've also managed 6 different funds. I'll talk about their track record here in a minute. But again, very excited to partner with them. This will be our 2nd fund with their team, and the 7th fund that Mahajer is going to be managing. Like I said earlier, our process for identifying deals, it's pretty simple. It's a top-down approach. We look first at what are the big economic trends in play and are likely to continue that support the investment themes that we bring to our investors. We want to be playing in a rising tide, right? A rising tide lifts all boats. And at any point of the economic cycle, there's always opportunity. And so we want to be investing where that opportunity is. And, alongside of that, we also want to create true alignment of interest. So we're putting together, best-in-class teams, investor-friendly structures, and then all of our principals invest in every single deal as LPs alongside of all of our investors to show true alignment of interests. And in our last fund, between Mahajer and the Aspen principals, we invested over, I believe it was $7 million into the last fund, and really put our money where we believe it's going to grow, and expect large allocations to this fund as well. Our track record, like I mentioned, been around for 12 years. We have over 800 individual investors and families that we serve. Over $250 million of investor capital that we manage, $600 million in assets, and to date have distributed over $65 million of distributions back to investors. One of my favorite numbers. Experienced a lot of asset classes. You've probably seen our podcast, and definitely encourage you to sign up for that. We're about to relaunch it here very soon with a lot of new investor-friendly and focused content at a whole other level. So we're very excited about where this podcast is going. And with that, let's get into the real meat of the presentation. So if you're familiar with the last fund strategy, this is really a very similar strategy, very similar structure to the last fund. So what we're doing is we're going and putting together a fund that's going to go and purchase likely multiple producing assets. And then we will take a little bit of leverage and extra cash and reserves to then use for drilling and development opportunities over time to continue to create more value. And so the great thing with this strategy, and how it's really different from a lot of other oil and gas investments that you see, is we really create the fund around anchor producing assets, right? We're not going out and taking a lot of capital and then going and drilling in, wildcatting or exploratory drilling and hoping that we hit oil, and doing that to get the big tax write-offs, right? A lot of times, most of the offerings that we see are, led with great tax incentives first, which are great, yes, but the strategy and the overall return is usually secondary, right? And we've seen a lot of different offerings, a lot of mixed results, and honestly, a lot of things that I would not say live up to our standard of excellence or professionalism of what we expect when we're investing in something. And so one of the things with our strategy is you get really the benefits of current cash flow, because we're buying existing producing wells that have already been proven. They are producing. They're operated by major operators. And then we use that cash flow and we leverage that back into more drilling and development to continue to increase overall value. So you get cash flow plus upside along the way, and a risk mitigated approach. I'm going to talk about how we mitigate those risks here in a minute. So our primary strategy is to purchase non-operated working interests, as well as the option to produce, to invest in royalty interests or mineral interests if the opportunity presents itself and it makes sense for the strategy that we're doing. And really our focus is the non-operating working interests. And what the advantage there is, you get a lot of the tax benefits you get from being a operating working interest, but you reduce the risk of operations by partnering generally with much larger operators. In our case, most of the ones we've worked with are publicly traded companies, very, very large, capitalized companies with a great track record, and mitigate a lot of those risks, but you can participate alongside of them and get the same benefits as you would. And even smaller types of drilling operations, but we're getting into much bigger operations and opportunities you could otherwise get into. Before we dive into some of the meat of it, I want to just give a quick plug here. If you have not watched a couple of our resources, I really encourage you to spend a little bit of time on this, because for a lot of investors, this is a newer asset class that you're unfamiliar with. And it is a little bit of the Wild West in a lot of ways for people that are maybe just investing in alternatives or have only ever invested in real estate. It's very, very different than real estate. And it's very, very different than investing in oil and gas stock, right? If you're mostly investing in stocks. So we put together a masterclass. We did this before we launched our last fund about a year and a half ago. But it's really the 101 of oil and gas investing, how to understand the landscape of opportunities, and really what are the key risks you want to look out for, what are the key things that you want to understand, and kind of the 101. This is a great base, kind of foundational masterclass for you to understand if you're kind of newer to the space. If you did watch this or you have invested in the space for a little bit, there's still probably a lot you can gain from it. So I still encourage you to watch it. But you can kind of skip to the second resource here. And this is something we just put out a few weeks ago with our friend Jeff Mahajer here. And this was a state of the market of oil and gas investing in 2025. So this was a live webinar that we did. We had a lot of people register, a lot of great attendance, a lot of great questions that we answered live. And you can watch the recording there at this link. And actually, it's going to be in the data room. And what we did there was address not really the 101 of what does it look like to invest in oil and gas, but we actually looked at what does it look like to invest in oil and gas in 2025, meaning with the new administration taking over the presidency, with all the current geopolitical things going on in the environment, what does 2025 spell for the oil and gas industry? And that's what we addressed in this webinar. So you can get a lot of that kind of background backdrop for why we're so excited about this fund in that webinar and why we think this now is an incredible buying opportunity. I'm going to give some of the reasons for that, but we spend over an hour going through this, and I really encourage you to watch it if you haven't. So again, education is so important, especially in a newer investment asset class. So be sure to spend some time to review this if you haven't. Real quick, some of the key reasons you might want to invest in a fund like this is, one, you're investing in a very experienced sponsorship team. Not only from the Aspen side of managing funds, working with accredited investors for over a decade, but also with the Mahajer Energy team, who's been investing in this asset class with this strategy for over 40 years and a 6-fund track record. One of our key things that we're really passionate about for investors is democratizing access to more opportunities, better opportunities that retail investors traditionally haven't had access to or have had limited access to. And one of the cool things about this fund and why it makes so much sense with the partnership with Mahajer is Mahajer historically had only ever raised money from large family offices. They had one big check writer, they'd write a big check for the acquisitions they were doing. But we said, hey, what if we come alongside you and we can bring a lot more investors, they're smaller check writers, but we can pull them together and we get access to the types of investments that the institutional investors are investing in, but to a broader audience. And that's what we've done here, because we're investing in institutional grade assets, right? These are usually very large checks, anywhere from 20, 30 million all the way up to several $100 million to be able to stroke a check to get a seat at the table on some of these deals. These are horizontal drilling programs. These are large wells operated by major operators. And so we're coming into an institutional quality asset, and we can buy in because of the pooling power that we have from bringing everyone together into a larger fund. And so by doing that, we get better pricing at the acquisition. We can go and negotiate better deals, and we're all diversifying our investment into multiple wells alongside multiple operators and an institutional quality asset. Cash flow and upside, right? It's not just purely tax benefits with the hope that we hit oil and we make a little bit of money. That can go very quickly the other way. You go invest in a drilling program, hey, you get some tax benefits year one, which is great, but those wells may not produce economically to where you actually don't make your money back, and it becomes a capital loss, right? And that becomes a permanent loss versus a tax loss on the front end, and that's something that nobody wants. And so this is very different. You get cash flow. We're buying cash flowing assets day one that produce a base of income that we can then leverage into more drilling to create more long-term terminal value and be able to sell into a market when it's a better time to sell. And so again, we're targeting a mix of distributions, which will be a nice cash flow and then a nice big exit once the fund sells down the road. And we've increased that terminal value through more drilling, expansion of our reservoirs, et cetera. Tax benefits, there are great tax benefits in this fund, so I want to be really clear on that, and I'll talk about that at the end. So it's different than some of the pure drilling programs that you're maybe used to. We will not be able to offset active income in this fund, but most of the income, if not all of the income that this fund generates, will be tax deferred. And a lot of those losses will be generated from intangible drilling costs, which are passed through to the investor and are true losses and do not have to be recaptured. So in a lot of ways, it's as good or better than real estate investing, with the benefit of lower risk because you're getting that cash flow, you're getting that upside, and you're not taking huge amounts of risk just to get a little bit of extra tax juice squeezed out of there. Contrarian thesis, right? It's good to be a contrarian investor in the right opportunities because a lot of times that's where you make the biggest the biggest growth in your portfolio is when you take a well-founded investment approach in something that the market is discounting for whatever reason, right? And for a lot of reasons, oil and gas has kind of been pushed aside as, oh, it's the ugly fossil fuels, it's the end of an era, we don't need these anymore. And I'm going to make a really clear case of why that's not the case. And many times the contrarian investors that go against the tide, that invest into an opportunity that all the data seems to say one thing, but the markets say something else, that's when the real opportunity happens. And that's what we're doing right here is we're investing into a contrarian theme, but it's a well-supported theme. And we believe a well-structured investment opportunity. And then lastly, co-investment. Like I said, our fund principals are all going to be investing in this fund as LPs alongside all of our investors. So you have confidence that there is alignment of interests. Okay. The track record, I mentioned that Mahajer has had a 6-fund track record. So you can see here, this is a little table of the 6 funds I referenced. 4 of those are realized, I mean, they've gone full cycle. And you can see those at the bottom. And so average IRRs between 21% and 76% of the realized IRRs. MOIC is multiple on invested capital, anywhere from 1.5 to 3.4 multiple on the capital that was originally invested. And the average hold time here, you can see here, is on average, including the open funds, the top 2, is less than 3 years. So we have designed this fund to be a 10-year fund, but we don't anticipate holding these assets for 10 years. What we want to do is be able to hold long enough to let the market kind of revert back to a seller's market, which will happen at some point in the future. We just don't know when. But we can sell into that market and generate a nice multiple because of the premium that's going to be paid for at that time. And again, we want to have enough runway to do that, but we don't anticipate holding it for full 10 years. You can see here the track record is really that. 40 Energy, this is an active fund, and their investors, it's still operating, have already have an unrealized multiple of nearly 5x and an IRR that they've unrealized of 72%. Fund 6, this is the last fund we did with Mahajer. This one is still deploying, still actively investing in new drilling and making new acquisitions, but already based on the reservoir valuations that we have of the wells that we are invested in, already have multiple invested capital of 1.5. This is again unrealized. These are gross numbers on 1.5 years and 36% IRR. So already you can see great momentum in that Fund 6 that we launched 18 months ago. Here's a picture of all the different investments that Mahajer's team has made over the past 40 years. So they have a lot of experience in the lower 48, have invested in all the major basins in the U.S. And again, most of what we purchased recently has been in the Scoop Stack, which I'll talk about in a minute. But again, they've invested all over in multiple different basins. A little more on Fund 6. So we raised $41 million in that fund. We've already made 3 large acquisitions, producing acquisitions, and 183 wells. So those 3 acquisitions included a lot of different wells. So we have access and diversification to a lot of different wells that are producing right now. We've already participated in 5 drilling projects that are just getting going, and we haven't even seen the lift on returns in those yet. And so that 36% estimated unrealized IRR is kind of based on the current reservoir analysis that we have right now. And that will likely grow over time as we do more drilling. Again, these are projections. This is not realized. I want to be really clear about that. So these are all just estimates based on reserves that we've gotten from recent price decks of the market pricing of oil and gas. We, in 2024, started distributions, actually started a year ahead of time. So we were producing so much cash and decided to start distributions a year ahead of time. So we have been paying out, depending on the share class you're in, between 15.1 and 17.7% annualized cash distributions. So if you're in Fund 6, you've been getting those checks, and most people like getting those checks. So expect that to continue to go on and to continue to increase as we continue to add more drilling and acquisitions to that fund. Fund overview. So this is the new fund. So Fund 7, the target fund size is $100 million. We're raising our $75 million is our target. We plan on having about 25% leverage, so $100 million in fund size total. Our minimum investment for this, depending, we have 2 different share classes we'll talk about, is $150,000. It's a 70-30 waterfall LP to GP. Again, like I said, 10-year projected hold period that we don't anticipate holding for that entire length of time, which really creates a broader opportunity time frame for us to be opportunistic when it's the best time to sell. We're targeting a net IRR of 25 to 30%. That's what our target was in the last fund. You can see we're already exceeding that on an IRR basis. If we hold for the full 10 years, our target equity multiple would be between 4 and 7x, which would be that IRR sustained over that period of time. Obviously, if it's a shorter hold period, that multiple would be lower, but the IRR we expect to be in that same range. Distributions are quarterly. We do anticipate a small amount of leverage, like I said, 25 to 30%, and that's going to be on the producing assets because it's there's a lot of lenders that want to lend on cash flow, right, from oil and gas. But we usually keep it lower than what you're even allowed to get to, up to 50% sometimes. We want to keep it around that 25 to 30%. And then we will employ commodity price hedging. So this is something that a lot of other funds aren't doing, but we think is really important for just investor, again, mitigating some of that commodity price risk that you have in a fund like this, where you don't have as much of that in other types of funds like in real estate. And so we generally keep it pro rata to the leverage to at least cover the debt service. Sometimes we do more of that hedging. Right now we're hedged, I think it's about 50% of our volumes in Fund 6 because we think the pricing environment is favorable based on the assets that we have. And so we're locking in the kind of spreads of those prices. And we still have the upside, right from that, but also reduces the downside. So if oil prices crash significantly, we have kind of a floor of what we can still sell at for a good portion of our volumes. Okay, about the fund, similar to last fund, it's going to be say a 1-year capital raise. Will likely be much shorter than that. We will leave it open potentially for up to a year, though it will likely be most of that capital will be coming in the first several months. And then if we have other opportunities, we may open it up to other investors down the road or expand the offering. But again, we're going to keep this kind of a truncated kind of raise period, and then the deployment period will be kind of the second part of that 1 year. So it's a 1-year capital raise and deployment. The capital raise will be on the front end of that. Deployment will be on the back end of that. We have the ability to extend that, and we think it's in the best interest of investors. We're accepting subscription in their first come, first serve. Capital will be allocated or accepted as acquisitions are made, and we'll operate more on a waitlist structure. The first year, the fund is expected to reinvest all the profits of any producing wells that we purchase back into new drilling programs to compound those returns, kind of kickstart that momentum on the values and the cash flow. And then we target distributions to start in year 2, and then thereafter growing over the life of the fund. So again, at Fund 6, the timing just worked out well. We decided to accelerate those by about a year. The distributions, that is. We don't guarantee it's going to happen in Fund 7. A part of that depends on what opportunities do we have. We have really good drilling opportunities that get in front of us. We're going to invest in those because it'll increase the overall return and eventual cash flow to the investors.
Thanks, Ben. Let's break down the target returns and exactly how your capital is positioned to grow. This is a growth-first strategy engineered for investors who want to deploy capital with maximum efficiency while unlocking significant upside in a sector positioned for long-term expansion. I'm going to now show you the base case scenario for your investment in the energy fund. So right here, you can see that with a 150K investment, you're going to get a full capital return in year 8 to 10, meaning your initial 150K investment is fully returned. Past energy funds have gone full cycle in an average of 2.55 years, but we're giving a longer runway to fully capitalize on oil and gas market dynamics. The projected total profit is $1,089,027, and there's a strong compounding effect. You can see profits scale exponentially in later years, leveraging that reinvested cash flow. Let's look at a year-to-year breakdown. So year 0, you're investing $150,000. There's no cash flow. Capital is redeployed into drilling new wells, compounding your long-term gains. Year 2 to 9, cash flow accelerates aggressively, scaling up to $74,592 annually. In year 10, the total payout is $1,474,361, including your initial capital. That's a 31% IRR, 8.83x equity multiple, and 29% cash on cash returns. This strategy maximizes reinvestment in the early years to compound returns over time, ensuring investors benefit from both steady cash flow and explosive long-term upside while leveraging tax advantages that enhance after-tax yields. Now, let's address the worst case scenario. What happens if external factors create unexpected headwinds for the fund? You can see here in the downside scenario, year 0, $150,000 initial investment. Year 1, no cash flow. Capital is still strategically deployed to expand operations and position for future gains. Year 2 to 9, profits build, but at a more modest pace, up to $11,227 annually. And year 10, the total payout is $453,436, including principal. Even in this scenario, the fund delivers 12% IRR, 2.02x equity multiple, and a 4% cash on cash return. Now, for returns to drop to the lowest range, we need to see a highly improbable multi-layered setback, such as sustained multi-year oil price suppression, which is unlikely given global supply constraints and rising energy demand. We would also have to see a complete freeze in new drilling approvals. This would require unprecedented, extreme government intervention. We'd also need to see major geopolitical events disrupting US energy production, unlikely given our focus on stable, proven domestic basins, and capital mismanagement or drilling inefficiencies, which we are mitigating by our best-in-class energy partners with a proven track record of maximizing returns. Even with these extreme headwinds, investors still see positive returns. Capital is preserved and cash flow continues. This is a risk-adjusted strategy designed to weather volatility while keeping investor capital positioned for long-term upside. And it is critical to note that this is still investing and there is always risk. And this is why we really want to demonstrate to you an upside and a downside scenario.
Okay, what's the fun strategy? So I've shared a lot of it. So some of this I'm going to kind of run through, but the opportunity is again, we believe now is an opportune time. I'll explain the reasons why here in a minute to invest and acquire direct interest in oil and gas plays and to position ourselves with long-term favorable economic fundamentals. So the short-term prices of oil and gas are likely range-bound. I'll explain what that means later, but we likely don't think they're going to move significantly one way or the other. But the long-term fundamentals suggest that long-term supply is constrained while demand is expected to remain constant, if not increase. It's going to put a lot of pressure on prices, upward over time. And the market currently is not pricing in this upside because a lot of the ESG initiatives and a lot of capital allocators that have dropped out of the space. And so our strategy, again, very simple. Partner with a very, very experienced team with a geological foundation to go in and purchase these assets alongside these major operators with a 6-fund track record. And we're, again, investing directly into a diversified portfolio of oil and gas plays in proven basins and getting positioned for upside through new drilling. I've already kind of said this a lot, but the idea here is buy existing production, use that anchor asset to reinvest back into new drilling to increase overall value. And our goal here in this fund is to maximize value and total return to investors. So we want to generate as much cash flow as we can, but our overall goal is to maximize that total return, that multiple on invested capital, that net IRR at the end of the day for our investors. And again, that first year's cash flow, we expect most of that to be invested back into drilling as opportunities are available and compound those initial returns. Okay, I talked about there's a lot of risks in oil and gas investing, right? So how are we mitigating some of these risks? Well, I've identified 4 key risks here that I think it's important for investors to think about. And if you're looking at other types of funds, right, compare how that compares with these risks. First is operator risks. Right. And I think this is one of the biggest risks in this space, especially because most of the offerings that I see are investing with smaller operators with less proven track records. They're vertical wells, not using the latest technology, and they're also much smaller. They're less capitalized, less of a track record. And so I think it's very, very important to understand how important the operator is in this type of an investment. And our focus again is buying non-operated working interests alongside established middle market and large operators, many of which are publicly traded in proven basins. So that's how we're mitigating this risk. Right? We're going upstream. We're going to the best of the best in this space and partnering alongside of them. So drilling risks, right? The other big risk in this is drilling, development. You've heard the terms maybe wildcatting, exploration drilling. And that is, if you're investing in a pure drilling investment, there's a lot of risk, right? Because there's so much, we talk about this in our 101 masterclass on oil and gas. There's so much that can happen when you're drilling. And especially if you're drilling in a new part of a basin or you're doing exploratory drilling and trying to find new reservoirs, it's very, very risky. It's very, very expensive. And so, you want to make sure if you are doing drilling that you mitigate that by investing in the producing, right? You're already guaranteed to get cash flow from existing producing wells, right? Versus the hope of generating something. But then we're also doing, and on the drilling that we do, it's generally infill drilling, right? So these are lower risk drilling opportunities where there's a very clear geology that's already been mapped out through a lot of 3D technology that's available today, and it's not going to drilling the first, second, fourth, fifth, 10th well in a new area. It's drilling the 500,000th well in a certain area that's been very, very well developed, and so it's really infill. So we know pretty well what the geology is. We know pretty well what the returns are going to be based on all the other data that we receive from these other wells in this area. And so when we're looking at a drilling opportunity, that's what we're looking at is really a lower risk drilling where you have really good data to understand what is the potential, because there's a lot of data available. Environmental risks. So again, there's some risks in oil and gas from an environmental standpoint. Our focus is on the lower 48 states, not offshore drilling. Most of the environmental issues come from offshore drilling. Right? You've seen all the oil spills and other things that have popped up in the news over the years. Most of those are related to offshore drilling, and that's not what we're doing. Also, we're reviewing the operator's insurance coverage as a key part of the due diligence process. So that really falls on the operator, though obviously if there's a significant issue or a claim, that can impact their ability to operate. But for the most part, again, these are very large operators, well capitalized. They've been doing this a long time. It's a much lower risk. And then finally, commodity prices. Right, this is something that a lot of people are not really thinking about when they're investing in oil and gas, but this is a commodity that you're investing in. It's a very volatile prices out there, and they can change very quickly based on a lot of different factors. And so one of the things that we're doing to reduce that risk is by hedging. I already talked about the hedging, which basically just means we're locking in prices for a portion of what we're producing in oil and gas to just smooth out some of the volatility and the changes in those prices. Now, we believe the case in the long-term potential is to the upside, but we're also mitigating for that downside. Okay, let's spend just a few minutes on the macro trends because, again, this is very important to understand of why oil and gas and why now. I'm not going to spend a ton of time on this because we did spend a decent amount in our last kind of state of the market webinar, but it is important to see some of these charts. And I think you'll be surprised if you haven't seen these before. Well, first off isn't fossil fuel, aren't they irrelevant, right? Haven't we moved on from those? Aren't we mostly green energy now? And that's been, a big barrier for a lot of people until they see a chart like this. And this is from just a couple of years ago. We looked at the recent data. It hasn't really changed, since this was a couple of years ago. But 83% of our global energy usage comes from carbon-based fuels. Only 17% comes from non-carbon. And that's despite over 50 years of investment, of incentives in technology, of solar, of wind, of these other types of renewable energies, right? And so it's 17%, but it's not nowhere even close to taking a stab at a majority of the production of usage of energy that we need. And so this is not going to change substantially in any short period of time. And we'll talk about why here in a minute. One thing I always like to do, I talk about contrarian investing a little bit earlier, is what are the bigger investors doing, right? Warren Buffett is known as one of the grandfathers of value investing. I was looking for something that the market is undervaluing, but he thinks there is upside value there. And this is a clip from Market Watch just a few weeks ago. Warren Buffett, the title here is "Ignores Wall Street. He buys more stock in this oil and gas company." He just invested $400 million in Occidental Petroleum, which is a upstream company. They are a producing oil and gas company, and he just bought a large position or upped his position in them recently based on he saw the values were there, right? So again, this is smart money. They're seeing the opportunities. They're seeing the same things we're seeing, the long-term trends, but in the short term, there's a disconnect, and that's where the opportunity comes in. We look at oil and gas. It's simpler to break it down by supply side and demand side, right? What's happening on the supply side and what's happening on the demand side. So let's first spend time on the supply. So supply, it's interesting to think about relative to maybe other asset classes like real estate, where real estate naturally appreciates over time, right? It goes up in value based on inflation, based on replacement costs, et cetera. Well, oil and gas is different in that it actually declines every year because there's a fixed amount of oil and gas in the ground, and then we use it, and that's called depletion. So there's a depletion of reserves in these reservoirs. It's about 2 to 5% of total production every year that gets depleted. And so, if you think about what that means, if we are not investing into any new development, every year our supply is naturally going down by 2 to 5%. So that requires continual reinvestment, continual capital expenditures for new drilling just to maintain a base level of supply. Um, and so every year, about 5 million barrels a day of new production is required just to maintain flat supply. So you think about not only is the pure amount of supply going down, but because we actually have a growing population and a growing GDP, we actually need more production just to maintain just flat supply. And if you see here this chart on the right, this is the investment of oil and gas exploration and development. And you look from the period of 2010 to 2015 all the way to the period now of 2020 to 2025. It's expected that there's been a drop in global spending in new exploration and development by over 55%. It's dropped by over 55%. So the new capital is coming into the market to go invest in new exploration and drilling has gone down by over half. And so that spells, down the road, we are going to have less supply than we do right now. And that's something that could change, but it's not a quick change, right? It takes time to invest into the new development with the permitting, with the exploration, and getting the capital for it, getting the equipment, et cetera, et cetera, et cetera. So it's not a quick thing you can switch all of a sudden. And this is a trend that's been going on for really over almost a decade now with that declining investment into oil and gas. As a result, global energy production today is severely supply constrained with no prospect of rapid increases. On the other side of it, talked about ESG initiatives, right? What's ESG? It's the environmental, societal, and governance standards that are being imposed on a lot of large capital allocators, like endowments, like pensions. And what they're doing is requiring them to invest a certain amount into green energy. They have to hit their green energy scores. And so what that does is it forces a lot of capital out of this market into the thing. That's why we're seeing a lot of declining investment into new drilling. And you can see here the collapse of private equity funding has substantially dropped. So this is the private equity money that's come into oil and gas investment, and it's really, really dropped. So at the same time, you have a decreased future supply. You also have decreased capital investment, which is reducing competition for these same assets. And from our standpoint, it's creating a really great buying opportunity to purchase at really good values. Well, let's talk about the demand side, right? Because this is where a lot of people say, well, yeah, we have declining supply, but we also have declining demand, right? People aren't going to be using oil and gas for very much longer as we transition fully to green energy. And that's simply not the case. And I'm going to show you here a couple slides that are really important to understand. So stick with me on this. So oil demand concerns are overstated. Here's a really interesting chart here. So you can see on the chart here, this is global real GDP growth. This is on a global basis. What is the gross domestic product growth year over year? So you can see it's kind of up and down, but if it's above that gray line, that means it's positive. It means there has been positive real growth. And real means after inflation, inflation adjusted. And so if you look since 1965, global GDP growth was positive except for just 2 years. And the average annual GDP growth has been about 3% per year. Why is this important? Well, I'll show you in the next slide. Oil demand is directly correlated to real GDP growth. So let's show it here. So this is a measure of what's called oil intensity. So oil intensity is the measure of how many barrels of oil it takes to produce $1,000 of real GDP, right? So it makes sense. If we want to go increase our GDP, we have to make investments into manufacturing. We have to hire. We have to create more infrastructure, whatever it is. And so to increase that GDP requires spending money and growth. And to do that requires oil. And so it takes, you can see by 1970, it was about 0.9 barrels of oil to produce $1,000 of real GDP growth. Whereas today, it's gone down to about 0.4 barrels today. So there's obviously been efficiency gained, but look at this curve. And so this is a beautiful chart for someone who likes statistics like me, where you see an R naught coefficient, R squared of 0.993. So that's basically the correlation of this decline in efficiency of oil intensity relative to this red line here, which shows that efficiency gain over time. So what that does, though, is it shows a high predictability of future oil demand. Right. So even with renewable energy adoption, even with efficiency gained from we can produce more GDP with less oil, if we're growing at all, right? If we have any GDP growth, we actually need more net oil to support that growth. And that's what I'm going to show you in this next chart. So this chart predicts what the baseline of oil demand will be if nothing else changes, right? If it doesn't mean don't worry about the supply side right now, just pure demand side. Right now, our demand is about 100 million barrels per day, and you can see that kind of bottom part of the red line is if you forecast out, that's where that's going to be. But if you have just the 3% growth annually to 2050, so about 30 years, if GDP growth remains consistent at 3%, which is what it's been for the past 60 years, global oil demand could reach as much as 140 million barrels a day. And if it's 4% growth or 5% growth, you can see how those charts get exponentially higher to 180 million barrels a day and up to 240 million barrels a day. But at just 3%, that's a 40% increase in baseline demand from where it is today. And this includes, again, oil efficiency gains and oil intensity. So here's some predictions by Exxon, and it's a little hard to see those small charts here, but on the left, it's oil. On the right, it's natural gas. You can see this kind of black line at the top. That's kind of the global outlook. So they kind of have it flat. They're not anticipating any increased demand, though we just showed, hey, it's a pretty high likelihood we're going to need more oil to support GDP growth. But let's say that that's not true. Say we don't have any GDP growth for the next 30 years, which is kind of hard to believe. But let's say that's true. You can see the green is the supply side. And so you can see there's a huge gap by 2050 of, in this case, nearly 60 million barrels a day, right? There's just a huge gap. Where's that going to come from? Where's it going to come from? Same thing in natural gas. They have a little bit of increase of demand for natural gas. But again, there's a massive decline in supply. Well, this is from JP Morgan. This is just in a couple of years. They're saying by 2030, they're expecting already a 7.1 million per barrel day shortfall of oil. And so you can see again that demand line, slight increase over time. They only have it going up to 105 million barrels a day of demand. Demand by 2030, which is probably pretty realistic. And then you can see the supply to start to decline, that red line right there. So that gap between those two lines, it looks small in the chart, but it's a big gap. They're saying 7.1 million barrels a day shortfall of the supply that we need to just meet basic levels of demand. What does that do, right? If you know economics 101, if you have limited supply, but you have demand, it puts a lot of upward pressure on prices. So again, we don't want to base our whole case off of, hey, this is, prices of oil and gas are going to go up, and so let's get on the front side of this and hope prices go up to make money. We want to make sure that the thesis makes sense now. I'm going to show you some of our assumptions and why that makes sense now. But we also believe there's long-term support for oil prices and gas prices to go up over time, and we'll see how that plays out over the next several years. So on the demand side, in the short term, we think oil prices, specifically oil, is range bound. What I mean by that is it's going to have a limited range of where it's going to trade because, again, we actually have a little bit weaker demand than a lot of people expected, mostly because of China's economic weakness. So U.S. demand is very strong. China has a lot of times been that incremental demand for oil, And that's right now being softened by some of our economic challenges. On the supply side, again, we're seeing some of those constrained supplies, the depletions hitting in, limited drilling, and so it's kind of two tensions of this rope right now are being pulled back and forth, but it's kind of in balance right now. But again, contrarian investment opportunity. It's a great time to buy and invest while near-term prices are counter to the long-term trends, where we believe the prices and the supply and demand equation will be more imbalanced over time. Let's talk about case studies. So these are going to be great examples of the type of assets that we're going to go after and show you the things we're going to be purchasing in Fund 7 that take advantage of these types of opportunities. So the first asset we purchased, this was in the Scoop Stack region of Oklahoma. This was in Fund 6. We purchased this for $30.5 million, had 140 gross wells, as well as 68 proven undeveloped locations, right? So the great thing right now, because a lot of that capital is out of the market, they're not competing on these assets like they used to. We bought these at a really, really good value, at about a 20% present value or 19% present value. And we didn't pay up for the upside. We didn't pay for that 68 new well potential. A lot of times you have to pay for that. And so this asset is producing annually about $8.7 million of cash flow when we purchased this in 2023, at the end of 2023. And again, 68 potential developmental drilling locations not built into the upside. When we bought this, oil was at $67, and the unvalued upside of the new drilling on the full cycle IRRs, again, these are infill drilling opportunities, was in excess of 50% on the other wells that have been drilled in those locations and areas that we were looking at. So very, very strong potential and very strong IRRs. That includes some of the ones that were not economic wells. Asset 2, also the Scoop Stack. The $10 million purchase. We got 29 gross wells, 5 proven undeveloped locations. This is producing $3.6 million of net cash flow to the fund. And again, not paying for the upside. This was purchased also, I believe, at a 19% present value. And one of the kind of cool things I like to point out here too is we have a diversified commodity mix of what we're investing in, right? It's not purely oil or purely gas. So in this one, you can see it's pretty mixed between 91 net barrels of oil per day, 97 net natural gas liquid barrels per day. And similarly with the other first asset, 358 of oil, 464 natural gas liquids. And so it's, again, you're reducing some of your risk by investing in multiple commodity types. We like to see that, right? Where you have diversification into multiple commodity types. Asset 3, this was a $6 million purchase, 14 gross wells. We got a really, really incredible value on this. We purchased this at about 25% present value, which was an incredible basis, and producing great cash flow to amplify what's already in the fund. And the kind of similar theme between these 3 assets is they all came from larger funds that were either ending the life cycle of the fund or the tail end of their fund. They wanted to divest and close the fund in one case. In another case, the seller was actually an operator that wanted to reallocate their capital to fields that they actually operated in. These were, again, non-operating working interests. So it wasn't in their core business. They got these as part of a larger purchase a long time ago. So they're selling these off. And again, it wasn't the primary focus for them. And so they sold them at a great discount. And then the last deal where we got really, really good price and basis on the asset was the seller. They needed a $6 million in this case. They just needed $6 million to fund. I believe it was another expenditure for another drilling project they were working on. It was unrelated to us, but they needed that $6 million. So they basically said, hey, what do you guys want for $6 million, right? And we had the cash in the fund. We're able to negotiate a really, really good deal and could close quickly so we can meet their need and secure the asset. So again, that's what we're planning on doing. We're going after bigger opportunities. We're raising a lot of money and pulling as much as capital as we can early on to go and have buying power in the marketplace to go and get, we don't want to call them distressed deals because the assets are not distressed, but there's usually stress on the seller for whatever reason that we can go and take advantage of a really good opportunity in the market and get really good values, and they can build off those values. Here's a little snapshot of some of the operating partners that are involved in those assets. Again, just examples of the types of firms that we're working with, and large operators. I think in this case, there's 8 different operators, and most of those are publicly traded companies, large, multi-billion-dollar firms. We're almost wrapping up here. A few more slides. Tax benefits. So I talked about tax benefits. Again, this is a little bit different than maybe what you've seen where other oil and gas opportunities have, a lot of drilling. There's no production that they're buying. It's pure drilling, and they can give you some tax benefits that you can use against active income to write off, against your taxes. That's great in a lot of circumstances. That's very different than what we're doing, right? Because in that case, it's a tax play with the hope of, investment return. In our case, total return is our primary goal, right? And then we want to do that as tax efficiently as possible. All right. So we really kind of, in our opinion, put the most important thing first, which is protecting and growing investor capital. And then the second thing is do this tax efficiently as possible. And so, there are a lot of tax benefits, and I usually say that they're as good or better than real estate, in the sense that the majority of the income that's going to be generated from the fund will be offset by, we have 3 different tax benefits. You have intangible drilling costs, you have depletion expense, and you have some depreciation. So all those get passed through to individual investors, and a lot of times that will offset the income being generated. Because the great thing is we're buying producing assets that are producing a lot of income. And so we are going to offset that, where that income becomes very, very tax efficient. To the extent that we do a lot of drilling and those losses exceed, the income being generated, then those losses can flow through to other passive income that you may be generating. And the great thing about intangible drilling costs, and again, I'm not a CPA, so talk to your CPA, make sure this works for you. But in most cases, they are not recaptured, similarly to in real estate, where you have a recapture event on accelerated depreciation. And so it gets a little bit sweeter in that standpoint, where a lot of those losses aren't just deferred, or tax benefits aren't just deferred. They can actually become locked in. So again, not an expert here. Talk to your CPA about this, how you can handle this personally, and receive a K1 for your investment in this, and that can be shared with your CPA.